Gupta, and today we will be covering the live revisionary virtual sessions on mergers and acquisitions and startup finance. So let's start with the mergers and acquisitions from a revisionary perspective, and then we will get into some of the fresh questions and assignment on the same topic. So students, in mergers and acquisitions, let's quickly revise what we have studied. So we have first of all discussed that what are the different types of mergers and acquisitions in which we can classify them. So the first one was, let's say there are two companies, company A and company B. Company B actually merges into company A. So from a legal entity standpoint, the B entity gets merged into A entity, right? And B entity gets dissolved. So we call it as a merger, and A now will carry the business of previous A and B. Both put together, the business will be carried on by A. So this is an example around merger because here the companies have merged and they have started the business. The new company, the A has started the business of collective merger. Now, the second case, students, was around, let's say there are again two different companies, A and B. So the A is the one which acquires a majority stake in B Limited. And A is a holding company which is having definitely a legal identity, a separate legal identity, and subsidiary company becomes B, right? Because the moment A acquires majority stake, A becomes a holding company and B becomes a subsidiary company. But the point here, the difference here is that B continues as a separate legal identity. B does not get dissolved. This is a form of acquisition. We call it as acquisition because we are acquiring the majority stake in B Limited. I hope this is clear. Then the third type of mergers and acquisition is where there is a company called A. It has two businesses, business one around textile and business two around perfumes. Then what happens? A continues the business one of textile, but what happens? A actually sells out the business of perfume to B. So it carves out from A itself. So B2 will be transferred from A Limited to B Limited. So that means business is getting carved out, students, from A Limited under the umbrella of B Limited. This is a case of demerger where a company is getting demerged and a business is getting carved out to a new company. The fourth type of merger and acquisition is about the business transfer, wherein we are talking about two different companies, A and B. Both of them transfer their businesses to a new entity called C, and both of them get dissolved. And in a way, both of them get merged so that their separate legal identity is not remaining. And finally, we have reached to C. So the C is where new entity is formed and the combined business will be taken by C. So they would be doing the combined business, students. How it is different from case 1? So the case 1 had previous company being continued, which is A. Correct? And B getting dissolved. However, in case number 4, both the companies are getting dissolved, A and B, and finally they are coming to C. Then let's come to the fifth case. Let's say there are two companies, A and B. A is the one which is into perfumes, and B is the one which is, let's say, the business line is deodorants and soaps. Now, what they understand that the deodorants is an extension of perfumes in terms of the business. So, what they feel is that this deodorants business can be transferred to A, which is operating on perfumes. So, what they do between A and B, they will continue their own legal identity. It's just that only the one business will get carved out from B, which is B1, and merged into A. Clear? Then, for purchasing this business, or let's say for doing any of the deal above in all the five cases, what we discussed, we also need to discharge a purchase consideration. What do we mean by purchase consideration? So, the purchase consideration is the amount that needs to be paid by the buyer to the seller for getting the company, getting the business, or getting, in any of these five cases, whatever we have discussed, students. So, in this present case, A will pay the purchase consideration to B, and B will transfer the deodorants business to A. Both A and B will continue with their separate legal identity. Correct? Then, for perfume and deodorant and soap, so once the business of deodorant is sold to A, there will be a business transfer arrangement that will be entered into. So, this is a contract under which the business got sold off. Now, let's talk about A Limited and B Limited. Right? In all the conversations, what we're talking about is that either one company is getting dissolved or the other company is getting merged. Right? So, this is how the things are moving. Now, let's advance our discussion ahead. So, A Limited and B Limited are two different companies. A Limited, in our example, will always be an acquiring company, which is actually acquiring the either the business or the entity. Target company is the one which is getting targeted to be acquired, which is selling its own business or getting itself merged with the A. Okay. So when A and B enter into a transaction in which B gets merged with A, yeah, when B gets merged into A, then the purchase consideration will be received by shareholders of B Limited because we cannot pay to B Limited itself. Why? Because B Limited is not having its own legal identity now. So B Limited will have to be merged with A Limited, and hence the shareholders of B Limited needs to be compensated. Then, students, we have also discussed about the different forms of a purchase consideration that can take place. The first one is around equity shares of A Limited issued to the shareholders of B Limited. So this is the first mode. So what happens, students? See, the easiest way to have a merger and acquisition or to buy a business or to buy a company is by payment of cash, right? You can actually pay it through cash. However, there are other ways possible as well. Reason being, because in case there is a shortage of cash or there is not so big free cash flow available, then what companies do, companies will issue equity shares of themselves to the shareholders of B Limited, in this case, which is the company which is getting merged, right? So, equity shares of A Limited will be issued to the shareholders of B Limited in consideration of equity shares of B Limited that the shareholders are holding of B Limited. Okay. Now, the second piece here is that it can be also in the form of a cash payment, wherein the purchasing entity goes and pays cash outrightly for the purchasing, and it gets paid through some of the free cash flows that the entity is holding. Simple. And the third option can be a combination of one and two, wherein let's say 50% of the purchase consideration is settled by shareholders, and another, sorry, is settled through equity shares, and another 50% is settled through cash payments. Okay. Now, in all the three cases, we need to know how the value will get computed. In the first case, what is the right swap ratio? So by swap ratio, we mean how many shares of B Limited against how many shares of A Limited. So this swap ratio has to be fixed. The second is for the cash payment, wherein the value of the payment needs to be agreed. Wherein we will say that what's the right value of the business or what's the right value of the entity that we need to agree. And then lastly, the combination of 1 and 2, right? Now, for computing the right valuation or even for computing the swap ratio, we need to know what all is the standalone values of A Limited and B Limited, correct? Then only we can say that what's my overall value coming out to be. Then we also need to calculate what's the right swap ratio that we will tell you with the example, and then post merger analysis. Why post merger analysis is important? Because before entering into a deal, we estimated that our future market price will be this much. We estimated that our future beta will be this much. We estimated that our future value will be this much. So whether after the merger our actually expectations are being met or not. That's the real purpose. Now P ratio is actually given as price by earnings, which is market price per share divided by the earnings per share. We are just revising this. P ratio is a multiple which tells you that in market at what multiple your 1 rupee of EPS is getting traded. Clear? And in this example now we are always assuming B is a selling entity and A is a buying entity. Okay. Okay. There is one announcement. BOS knowledge portal is now working, and the steps to join the session is log into your BOS knowledge portal using your credentials and click on join Zoom to enter into the session. Okay. So I am repeating, the BOS knowledge portal is now working. All of you can log in to the BOS knowledge portal, and after logging in, you can click on Zoom to enter into the today's class. Okay. Now, if B is a selling entity and A is a buying entity, then what is our swap ratio looking like? So it is it will take different meanings if we talk about different parameters. So the first one is market price based, right? If it is based on the market price, then MPS of A limited, which will be in the denominator, and MPS of B limited, which will be in the numerator. Clear? So let's say market price of the buying entity is 10 rupees and market price of the selling entity is 20 rupees, right? 20 is for B and 10 is for A. Then the swap ratio will become 20 by 10. Simple, 2 is to 1, right? So I will issue 2 shares of A limited for every 1 share of B limited. That's the interpretation. Okay. Similarly, if it is earning based model, then what we do is EPS on B limited divided by EPS on A limited. That's how we do. So this is on earnings basis. The next is around book value per share. So whatever is the book value per share for B limited divided by the book value per share of A limited. Now you must be thinking that which method we need to apply. So to which, if it is given in the question itself that which method to be applied, follow that method. If it is not given in the question, basis whatever facts that are given in the question. For example, you have been given market price per share only, then you will apply MPS, basis swap ratio. So book value per share is this formula. Then this one is a peculiar case wherein, let's say in case of mergers and acquisition of a bank, the NPA percentage is a big KPI, correct? The NPA percentage is a big KPI, wherein the banks can attribute some value or let's say swap ratio basis the NPA percentage also. Now here the formula gets reversed. So B limited and A limited are swapped in numerator and denominator when it comes to the above formulas. Why? Because this is a negative ratio. Higher NPA will mean lower swap ratio simply, right? Because if B limited is having a higher swap ratio, if it is in denominator, it will mean that the swap ratio will be lower. Then this is something that we have already known, which is how we calculate EPS. Earnings per share is calculated as earnings attributable to the equity shareholders divided by the number of equity shares. Now, the next part is, so till here we've calculated the individual values of equity, correct? And we have also calculated the swap ratio. Now, what we are doing is we are calculating the post-merger analysis around EPS and even market share and even market price, sorry. So the first one is around EPS after merger or post-merger EPS. How do we call it? We will go to the shares settlement mode first. So in case, let's say there is a merger and acquisition that has happened through a share settlement. So how do we compute the EPS after merger? This is the question. For that, what we will do, we will take the PAT of both the companies, PAT of A and PAT of B put together. And also we will add any synergy gain that we have forecasted or that has actually resulted into the synergy. So what is meant by synergy? Synergy is basically getting a benefit higher than what will be the standalone horizontal summation benefit. Now, this happens on account of multiple things. For example, there will be economies of scale. Once the merger happens, the company's scale becomes higher. Some of the overheads will be still at the same level, it will not increase. And even some of the overheads, there can be a savings also because the management will become common, and hence the management overheads will become same. So this is how the synergy gain comes into. It can also be a result of higher production. It can also be a result of the higher volume and hence higher sales. Correct. So this synergy gain is something once the two companies come along together. So there is a higher benefit to what they could have earned individually. So this is what synergy gain is. So we will take addition of synergy gain and then we will divide by the equity shares of A Limited. This is the existing one plus equity shares issued to the shareholders of B Limited. These are the new shares issued and these were the existing shares. Okay. This will tell us what's the EPS post merger. Now, in case the payment has happened through the funds, what are we going to do? We are going to take the individual parts. We are also going to take the synergy gain that we have spoken about. From that, we are reducing whatever is the cash paid multiplied by the return percentage. Reason being, whatever cash has been paid, on that there is an opportunity cost, right? And hence that return percentage is multiplied. 1 minus t becomes the tax rate equivalent amount. So this becomes the post tax, right? Because PAT also we are taking profit after tax divided by equity shares of A Limited. In this case, whatever were my existing shares will continue, right? Because I have not issued any further equity shares. Now, in this case, we were talking about synergy. So, synergy was the value of A and B collectively after merger will be higher than individual values of A and B combined. This is what the synergy is. And this can come from many things. For example, a common board of directors and management, a common supervision, lower overheads. The support functions will also be common, right? For example, the finance, the information technology, IT department, right? All of them can still serve the combined entity with the same level. So the support functions cost will be there. Then obviously there can be situations of the market power, right? So let's say earlier A was holding, let's say 20% of the market share, B is holding another 20%. Now collectively they hold 40%. So they have a market power now, right? In which they can influence the decisions accordingly. Also, please remember, students, one share pre-merger of B Limited is never equal to the one share post-merger of A Limited. Always remember this. Okay? Reason being, because there is a swap ratio. Since there is a swap ratio and hence the proportion can be different in different scenarios. Perfect. Then we were also talking about what are the effects on EPS post merger. Okay. Now, post merger EPS is something that we have calculated. Now, here we are trying to calculate the effect. How do we calculate the effect? For A Limited, the post merger EPS is something that we have calculated above. Less pre-merger EPS will also be given in the question, or let's say we will be knowing about what's the pre-merger EPS, and hence the net impact on A Limited will be just a difference between these two. But when it comes to B Limited, students, so the post-merger EPS of which one we will take? A Limited, right? Because B Limited is not there anymore. So the B Limited is dissolved. So post-merger EPS of A Limited is something that we will take. This will be adjusted for swap ratio, clear, less pre-merger EPS of B Limited. So why are we adjusting this for swap ratio? Because if you don't do, then you are inherently making an assumption that swap ratio is 1 is to 1, which is not the case. Correct? One share of pre-merger B Limited is not equal to one share post-merger of A Limited. Clear? So since we are not going to do this inherent assumption here, we are just simply taking the post-merger EPS of A Limited, multiply it with the swap ratio to arrive at the pre-merger, to arrive at the post-merger EPS of one share of B Limited, right? What's their equivalent EPS there? And hence the net impact on the target company's EPS is the difference between these two. So one share of A Limited post-merger is not equal to one share of B Limited pre-merger. Now, sometimes the question may ask, what is the value of acquisition? Now, the value of acquisition will be different from different perspective. Now, let's first talk about from A Limited's perspective. It will be value of the merged entity, which is A plus B, minus value of the acquiring company before merger, which is A Limited. So this is the A Limited's value pre-merger, and here it is the A and B both combined. Then if we talk about the gain or loss to the shareholders, if A Limited, from a A Limited perspective, if we talk about, then the difference between the market price per share pre and post merger will give us the gain or loss to the shareholders. From B Limited's perspective, the market price per share of post merger A Limited is something that we will take. This will be adjusted for swap ratio, and from that we will be reducing the market price per share of pre merger B Limited, right, to arrive at what's my overall gain or loss. Again, the principle here also remains same, that it is also adjusted for the swap ratio. Then if we talk about the market capitalization, right, it is basically the market price per share multiplied by the number of equity shares. Promoter holding will be 60% or X% or whatever it is given. If you have to calculate the free float market cap, then what we do, we just take the market cap and multiply it with by 1 minus promoters holding. So free float market cap means that the market cap that can float in the market on a freely basis, because the promoters holding is something that remains fixed, right? True cost of merger is basically gains to the shareholders of B Limited. It's a so gain from the perspective of B Limited will become the true cost of merger. And the value of the merger is actually the gain to the shareholders of A Limited. Clear? We will practice some of the questions to go through these concepts in detail, students. I'm just actually seeing we have planned for lots of different questions today, but let me just see if there is some other topic remaining to be covered. So the promoters holding and free float holding is something that we've already discussed, right? And it can be true for even the pre-acquisition and post-acquisitions both, right? So post-acquisition free float market cap will be what is my post-acquisition overall market cap, what is my post-acquisition overall promoter holding, and 1 minus promoter holding into the market cap will become the free float market cap. So this was a question around demerger, students, that we have discussed in detail in the sessions. So this was about how we carve out the one business from the overall business and how do we report it. And this was the question, students, where the NPA percentage was applied. And please do remember, in this case, the formula got reversed, wherein the NPA percentage of A Limited was there in the numerator and NPA percentage of B Limited was there in the denominator. Now, let's come to what is the rationale for a merger or acquisition. Now, there are different rationales that can prove a merger or acquisition to be a correct one. The first one is about the synergy. Now, if you talk about synergy between A and B individual values and overall combined entity, so synergy is one of the reason why people enter into merger and acquisition, because they feel that if they combine, they will be able to drive more value, more wealth generation compared to their individual values. The second piece is around diversification. So the diversification is basically where you bring other diversified businesses into your company. And we have also seen while doing the portfolio management, the higher you diversify, the lower unsystematic risk will be, right? We have discussed that risk is of two types, systematic and unsystematic. Systematic is there because of the system, because of the macro factors. Unsystematic is specific to that company. So the more you diversify, the more you reduce the unsystematic risk. And hence, between A and B, if let's say A is into the FMCG business and B gets into the real estate, so it's a complete diversification that will lead to the lower risks. The third point is around taxation. In case of taxation, there is a company which has accumulated losses which are available for a set off under the tax provisions. So what will the takeover, or let's say what will a merger and acquisition will entail here? It will entail that it can be adjusted against the future, um, against the future profits that the strong company will deliver, and hence to get the benefit of taxation, the merger and acquisition can happen. And there are rules in income tax laws as well which govern that how the settlement will take place in such a case. Then the next point is around growth. Now there is a limit to how we can grow organically in a business. By organic growth means that keeping the base same. Inorganic growth means that on the similar base we are able to drive higher growth through some inorganic means. Inorganic means through a merger or acquisition, by acquiring something. So let's say A Limited in year 1 is 1000 crores, in year 2 it moves to 1100 crore. We will say it is a 10% growth. But post acquisition, let's say this 1000 crore moves to 1700 crore. because 600 crore worth of turnover has been resulted inorganically. So this is an inorganic growth example which led to 600 crore increase, and 100 crore is an organic growth, right, which is coming on a base of 1000 crore. So this is how the growth triggers the mergers and acquisition, and it's one of the rationale for mergers and acquisition. The fifth point is about the consolidation of the production capacities and increasing market power. Now, assume that there are two companies which are competitor in the same lens. They have, let's say, they are controlling the production of the product for that industry. Between, let's say, A Limited and B Limited, they hold 60 and 10%. Now, if they combine themselves, they will collectively hold 70%. And 70% will have a higher delta. Or let's say it was 45 and 10%. So that means now they will collectively hold 55%, which is the majority. So in this case, it will mean a consolidation of a production capacity and increasing market power. Okay. So this also will be a rationale for why we want to do a merger and acquisition. The reason being, it will give you higher bargaining power in the market, higher influence that you can do the market by, let's say, setting a price in the market. You can be a leader in terms of setting the price in the market. Yeah. So then let's come to what are the different types and forms of mergers and acquisitions. So the first form is about the horizontal merger. Horizontal means what? Horizontal means like the line that we have drawn here, A Limited and B Limited, right? So this is horizontal. Now this effectively denotes that both of them are in the same industry. Now industry will mean, let's say, an FMCG industry. Industry will also mean, let's say, um, a textile industry, right? Where the common product, they all of them are linked to a common product or a service. Now, if these two companies merge, this is called as a horizontal merger. Vertical merger, wherein the there is a customer vendor relationship between two different entities. Let's say B Limited is related to A Limited as a vendor, and A Limited is related to C Limited as a customer, and they are getting integrated in between themselves. This is called as a vertical merger, right? Now, A Limited getting merged, or let's say customer getting merged into A Limited, is called as a forward integration, and vendor getting merged into A Limited is called as a backward integration. All of this will be done to consolidate the supply chain. The third one is around conglomerate merger. So the conglomerate merger is basically between the two entities which are totally unrelated, A Limited and B Limited. So B Limited is the one which is an FMCG one, and A Limited is, let's say, a perfume one, for example. So both of them are unrelated. So a merger of both of them is conglomerate merger. Co-generic merger. So co-generic merger means that there is some element of commonality between both of them, A Limited and B Limited both. Either they belong to the same industry or there are some factors that are common, example technology. There is a distribution channel which is a common one, or there is a production line that is similar. Sorry, there is a product line that is similar. For example, we talk about the business of giving loans. There is a NBFC which is giving an auto loan, and there is a NBFC which is giving a credit card. So they are, if both of them merges, then we call them as a co-generic merger because they have a similar product line in common in between both of them. Okay. Now, if you talk about these two, then these two will have different set of customers, right? Credit card will have a different one, and NBFC for auto loans will have a different one. The industry giving loans is the industry in which they are. The distribution channel is also uh, can be similar or can be different depending on the context, and there is a product line that is common. Correct. Then the next types and forms of mergers and acquisition is the reverse merger, students. So the reverse merger is where the private company actually takes over the public company, or let's say smaller company takes over the bigger company, and the private company takes it over with the objective of getting itself listed. Yeah. Then the next one is around acquisition. We discussed this, right? This types and forms of merger where we said that where a majority stake is acquired or we control the board of directors. So this is basically a acquisition, one of the types and forms of a merger. The next topic is divestiture. Divestiture is basically where you are diluting something. Now, the first part here is selling of the assets or the group of assets or a business unit is called as divestiture, where we sell off or where we partially sell off. This is called as slump sale of business, right? So, whenever we are doing a slump sale of a business, that is called as one of the form of divestiture because there we are selling it off. Second is spin off. Spin off means that we have two businesses. One business we are carving it out and transferring it to a new company, which is B Limited. So this is called as spin-off. The third one is about split up. Split up means that the same company is getting splitted into different companies. This is called as split up. And the original A company is getting dissolved. Then the fourth one is around equity carve out. The equity carve out is basically a spin-off, which is this one, plus issue of new equity shares in the market. Then the fifth one is around the demerger division of the family managed businesses, right? So, for example, if let's say there are within the family there are two divisions that has to happen, so this is another form of a divestiture, right? Because it's a division that is happening. Okay, clear? So the divestiture is all about diluting the stakes in a company through different forms and mode. Then there is a topic around financial restructuring. So financial restructuring is a process where we try to revive a sick company. What is meant by a sick company? A sick company is a company which has accumulated losses, huge debts, and there is a negative net worth. Now, how can it be revived? There are multiple ways. We can ask different stakeholders to forego respective amount. For example, equity shareholders, if it is 10 rupees paid up, we can convert it as 5 rupees paid up, so that now the equity share capital remains half, and that gain can be used to offset some of the losses. For loans or borrowings, we can ask, instead of 10%, it can move to, let's say, 7%. The next one is around, if let's say the loan is convertible into an equity, right? Rather than repaying in cash, can we get it converted into equity and interest will be avoided on equity? There can be some sort of a working capital credit from the vendors, and we can ask customers to pay us on time or even before time, right? So through this, basically we can revive some of the cash flow positions for the sick companies. Then we also talk about some of the ownership restructuring, how it takes place. The first one is going private. Going private means that we are buying back shares from the market to become private. For example, there is a company which is a listed company, right? They can go private by purchasing their own shares from the market and making sure that their shares are held privately. The second one is about the management buyout, wherein the management of the company, such as board of directors themselves, buy out majority stake, or let's say entire stake as well. If they buy out everything, that will become the management buyout. The third one is around leveraged buyout. Leveraged buyout means that you take a borrowing, and using that borrowing, we go and purchase the entity or a business. And through this borrowing taken, we discharge the purchase consideration. Okay, this is called as the leveraged buyout. The fourth one is around equity buyout. Sorry, equity buyback. So the equity buyback is something similar, right? Wherein we just go and purchase, let's say, equity from the shareholders themselves. Now, there are limits to this. There are some provisions contained in the Companies Act using which the equity buyback can be taken up. The next is around the special purpose acquisition companies, which are called as SPAC. Now, this is again a peculiar case where if we talk about IPO, there is an initial public offer that is done to collect the amounts from the public. So this is done to raise the funds from the public at large. Now that amount raised is kept in a trust or in an escrow account, which can be used once certain conditions are met. Right? Now, what are those conditions? Within next 2 to 3 years, they will look out for a suitable target company which can be acquired. Once the deal is, before the deal is getting finalized, the approval from majority shareholders will be required and will be required to be obtained. Until the time deal is finalized, money to be kept in an escrow account, right? That's what we have already said. The proper due diligence will take place, and once the approval is there, then the amount will be taken out from the trust or the escrow account and will be invested into that specific target company. Okay, these are called as blank check companies because the amounts that they are getting from the shareholders, it's just like a blank check, right? Because they have just mentioned the amount, but they don't know that who is going to be the beneficiary of this. By this, it means that who is going to get the investments proceeds. Okay. So the end use of proceeds will be known once the deal is finalized. Okay. Then students, let's quickly cover about the startup finance theoretical part as well, and then we can lock ourselves for the questions part for the balance of the sessions. So I think from a conceptual standpoint, we have covered mergers and acquisitions. Now let's move to the startup finance. Now, startup finance, first of all, we need to understand that what is the meaning of a startup. And there is a government notification that talks about that what will be the legal form of a startup. The first point is around whether it can be a private company, registered partnership firm, or limited liability partnership. Correct? So, what all it cannot be? It cannot be a listed entity. Because if it is already listed, that means it's not a startup. Right? So, it can be any one of the three. Second, it should be within the first 10 years of incorporation. The moment it moves to 11th year, it is not a startup because 10 years are good enough time for a company to establish itself. The third one is around the turnover. There is a turnover limit up to 100 crore. The next one is around the split or reconstruction of the existing business should not be regarded as a startup. So they are saying that come with a new business ventures. In case you have an existing business venture and you split it up into a new private company and call it as a startup, it is not. The fifth one is around innovation, develop or improve. Now it talks about some of the new technology that has to come in the form of a product, process, or service, right? Which should be actually kind of wealth generative for the people. It should generate employment opportunities, right? And this entire product or market or processes should be sellable. Clear? So if you do these five things, then you kind of, if you do these five kind of things, then you can be called as a startup. So first of all, we have defined what is a startup. Now, what are the different ways to finance a startup? Now, students, with all this discussion, one thing is very clear, right? That startups needs funding to start working. Now, how they can get funding? Through personal financing, through personal credit lines. Now, personal financing means that their personal sources of funds are used to do the financing. The second one is they have the personal credit cards that can be used for the startups because these are the people, the founders are the people which are very closely, mobilizing the resources to make a startup work. Then the third is about the friends and families. So they arrange some sort of funding from, let's say, the social circle of friends and families. The next one is about peer to peer lending. So the peer to peer lending is basically wherein one startup founder gives a lending to the another startup founder. Then the next one is around the crowdfunding. So the crowdfunding is a concept where there is a platform on which all the people who seek credit register themselves, and all the people, the small investors who can invest a smaller ticket size, also register themselves. So on this platform, the ideas are seen by the investors and they will get the smaller amounts of funding to fund their startup. So crowdfunding itself is a startup. Then microloans. These are the smaller, these are the loans that are available to the micro segments, right? Which banks also have a separate vertical these days where they give it for the priority lending. The next one is around the vendor financing. This typically means asking your creditors to give you higher pay terms. Let's say from 30 days to 45 days or from 45 days to 90 days. Purchase order financing. This means that once you receive a purchase order from a customer, you also ask for some advance so that you can fulfill the purchase order. So, sorry, in this case, what happens is that purchase order is given to the bank to get the funds so that you have a valid purchase order against which you will be supplying to the entity. Factoring accounts receivable, where you have a actual accounts receivable and you go and take the factoring of it. Right? And it can happen on two bases. One, it can happen on a recourse basis. Second, it can happen on a non-recourse basis. So the recourse basis is where the risk is not transferred. The non-recourse basis is where the risk is transferred. So on a recourse basis, it means that if the receivable is not made good by the uh, if the receivables is not collected by the person to whom we have sold the receivable, in case of a recourse, that person can come to us and claim the amount back. In case of non-recourse, the risk is already transferred and that other person cannot come back to us and claim the amount. So this is an example, right, where A Limited, there is a bank B. So A Limited was holding this accounts receivable. Bank B has paid to A Limited today, and A Limited has transferred this receivable to Bank B. Now, if C Limited does not pays to Bank B, then A Limited will make good the loss to the Bank B. This is called as a recourse basis, and the other one is non-recourse basis. So there is a concept of unicorn, students. It means that where the business valuation has reached $1 billion, that is called as a unicorn, right? Then we also talk about what all things should be part of the pitch presentation. There has to be an introduction. There has to be about the introduction about the team. What is the problem that they are going to solve? What is the solution? How the marketing and sales is working, right? And then what are the different projections about their ideas? Who is the competition? What is the macro environment? What's the business model that they're going to use? How they're going to do the financing bit, and what's their right valuation? So this is something that goes as a pitch presentation when they ask money, when the founders ask for the money to the different investors. Then what are the different modes of financing for a startup? So these are the different modes. The above one were the innovative ways to finance a startup. Now, what are the different modes? The first one is bootstrapping. Bootstrapping means that checking it internally what is available with you. right? It can be in the form of a working capital, increased credit period from the vendor, right? Uh, the leasing bit wherein you decide to lease the assets rather than purchasing them outrightly. And then obviously factoring, wherein you are realizing your trade receivables earlier than when it should be, right? Just now we discussed. Then there is angel investors. So angel investors are the one who are basically high net worth individuals who are okay to invest into a business on a one-to-one basis. So these are just like an angel because they give money and they also give that confidence and trust to the promoter or to the founder that once the business flourishes, then the money can be given back. Then the third is about the venture capital. So venture capital is one form of a private equity. As we know that public equity is the one where it is the entity is listed on a stock exchange for public at large will invest into it. Private equity is the one which is closely held and private, right? So how the private equity works is that there is a private equity firm, there is a SPV that it gets floated. So the contributions will come to SPV from so there is a pool of fund that will get generated from certain limited partners, which are high net worth individuals, banks, financial institutions, and pension funds which are ready to invest. There is a manager or advisor who will be actually managing or advising the entire investments. This SPV will be held in the form of a trust, and then using this pool of funds, they will shortlist some of the startups in which they will want to invest. And the ultimate idea is that buy, then grow, and then sell, right? Buy at a certain price, then grow through different interventions 6 to 7 times, and then finally sell it off. Okay. Then private equity investing, apart from investing, it also helps in providing the governance to startup because they are not only responsible for investment but also make sure that the investment grows. And there will be a one director on the board of directors to give them that governance, that decision making, right? They make decision on behalf of the startups, and there is a aggressive growth mindset for the business that happens for this private equity. Okay. Then there are different structures, students, that takes place for a venture capitalist, right? These are domestic structures and offshore structures. Domestic structures, everything is within India, right? All these parties that we have talking about. Offshore structure is basically two. One is offshore and second is unified. So in offshore structure, the SPV is outside India, the manager is in India, and the investment is also India. So that means the funding which is getting invested, the SPV is based out of India. Unified structure SPV is outside India, but the investments are also coming from outside India and within India. And the trust and manager are based out of India, right? Now these are different characteristics as we have already discussed, right? There is a long-term horizon, and obviously there is a lack of liquidity, right? Because we talk about 5 to 10 years or 3 to 10 years, there is a high risk and there is a equity participation in the entire scheme. Now, what are the advantages of a venture capitalist in a business? It's all about a long-term equity. Business partners are there, then there are directors, contracts about the value addition, additional round of funding, IPO, and then finally trade sale. Then there are different stages, right? Seed money is where they actually give a money for a pilot, for understanding the idea. Then there is a startup, first round, second round, third round, depending on how they have closed it, right? In terms of the investment process, how it happens, first there is a deal origination that happens, right? Wherein they understand about the deal. Screening is where they go about validate some of the facts. Due diligence is where there is a detailed investigation on what is being presented. Then obviously there is a deal structure, post investment activity, and there is an investment plan. The last topic around startup finance is about the succession planning of the business and why it is important, because startups are generally carried out by individual promoters, co-founders, and there is a succession planning also needed so as to make sure that the business legacy that they have created continues, right? So why there is a need? First of all, there is a risk that needs to be mitigated, right? Tomorrow the risk arises that who is going to success the uh, let's say owner of the business. Then for that it has to be mitigated. If there is a cause removal means that there is um, some non-compliance that has happened to some of the provisions, and then there is a removal of a director from the office. Then obviously we have to build a talent pipeline, because the talent also needs to be grown internally. What about the conflict resolution in this case, specifically when it comes to the external hiring and the internal hiring? Then obviously aligning. The last one is around the business succession strategy. How should we do that? While strategizing this, first of all, we need to identify which are the key positions. Then, what are the competencies required for those positions? And then we have to also identify what is the current workforce competency. And in case we need to have a bridge leader means that for 1 year, some interim leader will be leading, and then later on, a final leader will be coming. Then finally, what are the challenges of succession planning? It has to come with a founder mindset, right? Because the founder can behave like a founder. Nobody else who succeeds the founder can behave like a founder, because founder has different mindset. Then it can be a premature thing for a startup. Reason being, startup this involves the cost and efforts, right? And founders are the face of the startup. So lot of places you cannot think of a proper succession planning for a founder, right? Now let us come to the questions, students. Okay. So we did a quick revision of the topics. Now I'm starting with the questions. So these are the additional questions on the assignments that we are going to cover today. Okay. Now the question one. Alpha Limited is considering acquiring Beta Limited, and we have been given the alpha and beta both, the market value of the equity and the debt, right? What's the equity and debt we have been given? Alpha estimates that after acquisition, annual after tax synergy will be 36 lakhs forever. So they are saying that 36 lakhs is going to be my annual after tax synergy savings. Cost of capital is 12%. The integration cost is 50 lakhs, which is one time. So this I will incur, because once the business gets merged, I will be incurring some integration cost. Alpha offers a premium of 25% over beta's equity value. Calculate value of synergy, acquisition premium, net gain from acquisition, and whether alpha should proceed or not. Okay. So there are these different things that has been asked us to calculate. So the step one, let's calculate value of synergy. Okay. So the value of synergy is basically calculated using the present value. So 36 lakhs is my overall cash flows divided by cost of capital 12%, right? This is synergy. This is cost of capital. So we arrive at 300 lakhs, right? So the second one is about the acquisition premium. Okay, so the acquisition premium will be computed how? So Alpha offers a premium of 25% over beta's equity value. What is the beta's equity value? 400. And 25% on that will be the premium, right? So premium 400 lakhs multiplied by 25%, which is 100 lakhs. So this is the premium that has been paid. Now the next one is about the net acquisition gain, right? What's the gain from the acquisition? So how do we compute that? Let me write it. Net gain. Okay. So the net gain will be given as whatever is my synergy minus whatever I have paid as a premium minus the integration cost. Correct? So ultimately, the net gain to the overall mergers and acquisitions will be all the incremental factors, right? One, it is synergy. Second, there is premium. And third, there is integration cost. Synergy 300, premium is 100, integration cost was 15, the given in the question. So this becomes 150 lakhs. So the net gain becomes 150 lakhs. Okay, and finally, what is our decision? Our decision is that acquisition should be proceeded with as it is overall gain. Since net gain is positive, the acquisition should be proceeded. Okay, perfect. Now let's come to the second question, students. Right, so this one is done. Then second one is Sun Limited wants to buy Moon Limited. Current market value of Moon Limited is equal to 600 lakhs. Expected benefits is cost savings. Present value already given 150. Tax shield of another 80 lakhs will come. And cross selling benefit that will come, the present value of which will be 70 lakhs. There is an integration cost of 40. Determine the maximum acquisition consideration the Sun Limited should pay. Obviously, I can pay the maximum amount of whatever incremental benefits I'm getting and whatever is the market value of the target. Correct? That should be my maximum price. So solution 2 will be maximum value of target will be. First of all, let's calculate the total synergy value. This is going to be a sum of all, right? All the three presents value that are given to us 150, 80, and 70, which is actually 300 lakhs. Okay. Then the integration cost is 40 lakhs. The maximum value of target will be 300 lakhs minus 40 lakhs, 260 lakhs, right? So, sorry, this is the maximum, or I can say the incremental value maybe. And hence, the maximum value of target will be 600 lakhs plus 260 lakhs, right? 600 is the base price, the base value, sorry. 260 lakhs is the incremental amount that we can give. So this comes out to 860 lakhs. Maximum purchase price is 860 lakhs. Clear? Let's come to question number 3. A Limited, the earnings is 240 lakhs. Shares are 30 lakhs, the count. Price earnings ratio is 12. B Limited, similarly, the earnings are 80 lakhs, shares 10 lakh, and PE 8. Acquisition through share exchange based on the market price. Calculate exchange ratio. Post merger EPS is EPS accretive. Simple. So it's a question on what's the current exchange ratio that these guys should follow, what's the post merger EPS, and is EPS accretive. Simple. Solution third. So step 1 is to calculate the market price, right? Because we have been given earnings. We have given the P ratio, but we have not been given the market price. So let's talk about A Limited first. So 240 divided by the count of shares, 30. So that means 8 per share is the EPS, and market price per share will be 8 per share into 12, which is actually 96. Then EPS is 80 divided by 10, right? Which is 8. This is for B Limited, and MPS is 8 per share here multiplied by P ratio of 8 and EPS of 8, which is actually leading to 64 rupees of B. Step 2 is about the exchange ratio. Now, this is a exchange basis the market price, right? So we have to calculate the exchange ratio basis the market price. Market price of B Limited divided by the market price of A Limited. So this is 64 divided by 96. So this is actually 0.6667, right? And then the shares issued is at 10 into 6.667 lakhs. How I have taken 10 here? Because 10 lakhs is the count of shares, students, right? So for a total of 10 lakh, 0.667 swap ratio will get multiplied, and hence these are the number of shares. Then we have a post-merger shares issued is actually 30 plus 6.667, which is equal to 36.667 lakhs. Our combined earnings is how much? 240 plus 80. Is there any synergy benefits? No. So the overall amount comes to 320. What's my new earnings per share? It is actually 320 divided by, this is the overall earnings divided by the post-merger shares. So this is coming as 8.73. So the EPS rises from 8 to 8.73. Clear? So yes, EPS is accretive because the pre-merger EPS of A was 8 and now it is 8.73. So EPS is accretive. Clear, students? Let's come to the fourth question. We have been given P Limited and Q Limited earnings 500 shares, earnings and shares determine the exchange ratio so that Q shareholder suffers no EPS reduction. Okay, now this is a tricky question wherein we are trying to protect the EPS of the shareholders, right? Now, how do we do that? First of all, we need to calculate the EPS. We need to calculate the exchange ratio basis EPS. That exchange ratio will protect the EPS of the target company. Yeah. Limited 500 divided by 100, the EPS is 5 per share. So we can just put calculation of EPS. Q limited is 120 divided by 20, which is 6 per share. So if you see the target company, so who is acquiring whom here? So the Q don't suffer an EPS dilution. Q is getting acquired. I think this fact we need to just put it here that P Limited is planning to acquire Q Limited. Okay, this is something that we can put. So Q Limited, which is a target company, is having a higher EPS. Correct? We just now saw it is having a higher EPS of 6 per share against the EPS of 5 per share of P. So hence the exchange ratio will also be more than 1. Correct? So we have to put it as EPS of P Limited, which is 6 by 5, which is actually 1.2 is to 1. There's 1.2 shares of P for each share of Q is something that we will have to do. Clear? Then we move to, okay, before we move to the next question, I think, no, before this, sorry. So that I'll just complete this so that there is no dilution for Q Limited. Okay. So, students, let's take a break of 10 minutes and then again reconvene with the balance questions. Thank you. move to question number 5. Following question number 3, assume market perceives a higher risk and combined PE reduces from 12 to 10. Okay. Calculate post-merger EPS, new market price, and wealth effect on A shareholders. So it is saying that the question number 3, we knew that A Limited has a PE of 12. Now it has gone to 10. Now with this new piece of information, we have to calculate the EPS, market price per share, and the impact on the wealth. How can we do that? This is question number 5. So first, let's write what was our earnings per share, the combined earnings per share. So let's go to solution number 3, 8.73, right? The combined earnings per share from solution 3 above is 8.73 per share, correct? The market price. Now, while calculating the market price, students, we will multiply it with the new PE ratio, which is 10. New PE ratio. So this comes out to be 87.30 per share. Market price is equal to 87.30 per share. So original A share price was how much? The loss is 96 minus 87.3, correct? Because 96 is the current value, 87.3 is the previous value, right? So this comes out to be 8.7 per share. This is the loss, right? And if we talk about the percentage loss, it is 8.7 divided by 96 into 100, which is effectively 9.06 percentage. Clear, students? So with the new PE ratio, the valuation has changed. With the revised valuation, we have computed that what is the per share loss that A's shareholder will have to incur. So around 9.06 percentage is the value drop that they have to incur. Okay. And had this question be asked from the B's perspective, right? Let me just extrapolate this. with the case scenario of B. $87.3, right? Market price post merger. And what was the swap ratio? 0.667. So adjusted. So if we multiply 87.3 with the 0.66667, just a second. This comes out to be 58.20, right? Now this is a market price adjusted for swap ratio less market price for T limited before merger. That was 64, right? So students, the only difference here is that we have to adjust for the swap ratio here. That is the bigger difference, okay? That is why I'm just putting it separately over here. And hence it becomes the difference between these two 5.8. Yeah. So there is a loss to the B limited shareholders as well. This I have done extra. This was not needed as part of the question, but I have done it extra just to make you understand that while we compute the benefit or loss to the shareholders from B's perspective, we have to adjust for the swap ratio, students. Clear? Then let's move to the next question, question number 6. Merged company earns 450 lakhs. There is a company that has already been merged that is earning 450. Outstanding shares 100 lakhs. It repurchases 10 lakh shares. Out of 100 lakh, repurchase happens for the 10 lakh shares. EPS before buyback, EPS after buyback, and then percentage increase. This is something that we have to calculate. Without any additional information given in the question, students, we will assume that the merged company's earnings remains constant. Before buyback and after buyback. Clear? Before buyback. The earnings per share is actually 450 lakhs divided by 100 lakhs. 4.50 per share. This is before buyback. Then if we go after buyback, the earnings per share is actually 450 lakhs. The earnings remain same even after buyback, although the impact on earnings would have been whatever amount we have paid to buybacks. Okay. that would have been adjusted in the overall earnings. Divided by the 90 lakhs is equal to 5 per share. So there is an increase of 5 minus 4.5, which is equal to zero point 0.5 per share. In terms of percentage, it will be 0.50 divided by the 4.5 into 100, which is 11.11 percentage. Clear? So this is the increase that we're talking about. But now the question comes here is, if in this question itself, it was given additionally, sixth question, right? If it was given additionally that price of buyback, let's say 2 rupees per share, or else assume it to be 20 rupees per share. Okay, that's the price of buyback. Tax rate, let's assume to be 20% as of now. Cost of capital, let's assume to be 10% for now. So these three things are given you extra. And now for the same set of question, if we have to answer, then we will actually introduce these elements as well. So this is again solution 6 basis additional info. What is that? The solution 6 basis in additional info. The EPS before buyback is 4.5 per share, right? Now EPS after buyback. So 450 lakhs is going to be the earnings minus. Now because buyback will involve payment of cash to the shareholders. So that means effectively my earning potential will be lower to that extent, correct? 20 rupees per share, 10 lakh shares was bought back. This is the overall amount of buyback. But on this, 1 minus tax rate of 20% and 10% return of cost of capital that will be multiplied. Clear? So, whatever amount we have paid for the buyback, on that, whatever will be Yes. So we were discussing about that what is going to be the EPS after buyback in case we are going to fund the buyback through the cash or let's say our own sources. Then the implication that we saw is that from this 450 lakhs, which is my profit after tax year on year, that will go and reduce with the opportunity cost of this amount that we are going to pay, right? So this is 200 into 10% will be 20, 20 into 8. Uh, so this is 16 lakhs, right? So 450 lakhs minus 16 lakhs. This is going to be my overall profitability. So 450 minus 16 and then divided by what is the number of shares? Number of shares were 90 lakhs, right? So EPS after buyback is equal to 434 lakhs divided by 90 lakhs. If we do this, we arrive at 4.822, right? So with some additional facts in the question, students, the the response also changes, right? Because in this case, we have to adjust for the opportunity cost and the tax on the cash payout that we have given. After buyback, it comes out to be 4.822 per share. Okay. So this was around question number 6, basis the additional info that we have put in there. Then let's come to question number 7. A company has equity share capital of 400 lakhs, preference share capital of 100 lakhs, debenture of 200, and there is a debit balance in P&L that is, it's a loss. It's an accumulated loss of 350 lakhs. There is a reconstruction scheme wherein we will reduce equity to 40%, preference to be reduced by 50%, and debenture interest waiver rupees 20 lakhs. This is the debenture interest waiver that is going to come. Calculate the reconstruction benefit. So it's just simple that what is going to be my ultimately reconstruction benefit because of these different arrangements that has been reached out with the different stakeholders, right? So let's come to solution 7. So first of all, there is a equity reduction. The equity will be reduced to 40%. That means it will be reduced by 60%. So 400 lakhs is the equity value multiplied by 60%. So that comes out to be 240 lakhs, right? This is the equity reduction that is coming. Then the preference reduction is reduced by 50%, correct? The preference shareholders value is 100 lakhs into 50%, which is 50 lakhs, right? Then interest waived. The benefit of this is 20 lakhs, right? This is straight away given in the question. So the total benefit from restructuring comes out to be 240 plus 70, which is 310 lakhs. 310 lakhs, correct? So as we have discussed in our theoretical discussion in the first half, that for a sick company, there are different ways to revive, right? So some of the ways are discussed here. How can we go for a equity reduction? How can we go for a preference share reduction? And similarly, some of the interest waiver from the debenture holders, right? So this will help them to revive the cash flows. Again, a simpler question. Question number 8. Market value per share is 120. Acquirer wishes to purchase 51% and there is a control premium of 30%. Calculate the offer price, additional value paid per share. So with this information, they are asking us to calculate what should be the offer price and what should be the additional value paid per share. So students, this control premium is nothing but it's one form and adjustment in the valuation to arrive at the correct value arising because of the transfer of the control, right? Because that certain percentage can give you the entire control of the operation and hence there is a premium expected on the transfer of the control. Okay. So this is solution 8. First of all, let's calculate what's the overall. Okay, let's mention what is given overall market, or let me assume simply the market price per share. This is given as 120 rupees in the question, right? Target acquisition is 51% stake, right? Now, there is a control premium of 30%. Now, how does it translates to numbers? So, I am ready to pay higher amount of 30% in case I'm getting 51% of the shares, correct? Because I'm getting the control with me. So this is the meaning of control premium. So let's first calculate calculation of control premium. Okay. So this we will calculating how we will be just taking the base price of 120 rupees and taking the control premium. This is base price. This is control premium. So this comes out to be 36 per share. Yeah. So we are paying 36 rupees per share as we are okay to pay up to 36 rupees per share as premium. Now, what is going to be my offer price? Calculation of offer price. Base price which is appearing in the market will definitely be required to be paid, right? There is an expectation that it should be paid plus premium 36. So in totality 156. So this is going to be my offer price that I am going to pay is 156 per share. Okay. And the second part of the question was, which we have already calculated, that what is the additional payment that we are going to make. Additional payment, which is actually the premium amount, is 36 per share. I hope this is clear. We can move to the next question. Question number 9. There are two companies again, A Limited and B Limited. The EPS is given, book value per share is also given, and market price is also given. They have given us weights. Now, while doing the revision, we discussed, right, that one, we can calculate the swap ratio basis the facts that are given in the question. Now, in this question, they have asked us to calculate basis these weights. So we will calculate the individual swap ratio for each of these parameters, apply the weights to it, and calculate the overall swap ratio. Okay. So this is around weighted swap ratio, correct? Let's calculate the individual swaps ratio first. EPS. Okay, let's calculate the swap ratio basis EPS. Let me mention like this. Swap ratio basis EPS of which one is the target company and acquiring company? Sorry, B Limited and A Limited, right? So EPS of B Limited divided by EPS of A Limited. This is the basis. This is the calculation now, right? 10 divided by 50. 0.667. Right? Then the second is basis the swap ratio basis. We can mention EPS here, and here it is book value per share, the second one. So this is book value per share of B Limited divided by book value per share of A Limited. So this is actually 80 divided by 100, which is 0.80. Right? And then finally, there is a swap ratio. This is market price per share, right? So market price per share of B Limited divided by market price per share of A Limited. So this is 120 divided by 180. 0.667 again. So basis MPS and basis EPS, the ratio is coming out to be the same. Basis book value per share, the ratio is coming out to be a little higher. Right? Now, let's put down the weighted swap ratio. How do we calculate that? So this is basis EPS, BVPS, MPS 0.667, 0.80 and 0.667, right? These are the swap ratios. These are the swap ratios. Then we will put down the weights to it from the question. So it is given as 40, 30 and 30. Then weighted swap ratio is 40% into this 0.667, right? So this is 0.2668, and then 30% multiplied by 0.80, which is 0.24. Then 30% into 0.667, which is 0.2001. The overall number comes out to be 0.7069. So effectively, it means that 0.707 shares of A for each share of B. For one share of B, 0.707 share of A needs to be given as a swap ratio. Right? I hope this question was easy, but this is again just to reiterate the fact that the swap ratio calculation is a very important element in the entire mergers and acquisitions, because this forms the basis of how many shares will be issued, what will be the eventual gain or loss to the respective entities later on. Okay, let's move to question number 10 now. This was solution 9. Question number 10. Healthy limited assets are 1200 lakhs. Sick limited assets is 700 lakhs. Healthy limited shareholders received 70% equity in the surviving entity. Can the transaction be qualified as a reverse merger? Now, there are some asset tests that we need to do before we say that, okay, the transfer is a reverse merger or not. What are they? Solution 10. So, reverse merger requires what all elements? The first one is assets of the transferor exceeds transferee. That means the target company's assets should be higher than the acquiring company's assets. Okay, exceeds transferee. Now here 1200 lakhs is greater than obviously 700 lakhs, right? So yes, this condition is satisfied. Because the healthy limited's assets are more than the sick limited. Second, Is there a change in control? Yes, 70% ownership is received by the Health Limited. Correct? So this actually qualifies as reverse merger. So in a way, in this case, the the sick company, the name is as sick, right? So the sick company is actually acquiring the healthy company. Now again, the next question is around the special purpose acquisition companies, right? So some of these questions are actually very straightforward, right? These don't involve big amount of calculations to be done. But these are basically to clarify, or let's say to bring out some of the thoughts how we can or what, or let's say what are the concepts in the market. Now, while revising, we studied that SPACs are special purpose acquisition companies, right? They don't have a current deal as of now in hand. Rather, they can act, they take the amount and put it in a trust or in a escrow account, and then they venture out for a deal. Once they venture out for a deal, before finalizing the deal, they will take shareholders' approval, and then they will actually give the amounts to the shareholders, right? To the for the investment purposes, right? Now here we are saying the SPC has raised 800 crore. The target valuation of which they have acquired, or which they are going to acquire a target, the valuation is 750 crore. Obviously, once you acquire a company, you incur transaction expenses of 30 crores. So you need to calculate what's the remaining cash and what's the percentage fund utilized. I think remaining cash is easy, right? We just need to do a simple maths that overall proceeds is 800 crores minus targeted investments that we are looking at is 750 crores minus transaction expenses is 30 crores, sorry, 30 crores, yeah. So in a nutshell, we are left with how much? We are left with 20 crores. So the cash balance is 20 crores. Now, what is my utilization? Obviously, utilization will be overall funds utilized divided by overall funds received. Correct? So this is basically 780 divided by 800 into 100. So this is actually 97.5%. Clear? So this was a unique question on special purpose acquisition company students. Then let's move to question number 12. Again, the target value is 1000 crores that a company is aiming to acquire. Debt financing is 70% and equity financing is balance. Calculate the debt equity structure. So equity financing balance will mean that 30% of the funding will come from equity. Although the question is very, very easy, but the point here is that can you know which type of merger or acquisition is this? So, basis what we have discussed, right, and what we have understood, this is a leveraged buyout, LBOs, right, which happens through taking a loan, taking a debt, and then acquiring a company. So, this is an example of leveraged buyout where we are taking a debt, taking a loan, and acquiring a company, which is actually funded 70% from a loan and 30% from equity, right? We have to calculate the debt equity structure, right? So it's relatively easy. So this is specifically a leveraged buyout. Target value is some 1000 crores. Debt financing is 70%. Equity financing is actually balance, right? That is given to us. Calculate debt equity structure. Correct? So the debt here is 1000 into 70%, which is 700 crores, will be funded from debt. And balance is about equity, right? So 1000 into 30%. So 300 crores will be the equity. Clear? So that means the debt is to equity, which we are calling as a debt equity structure, is 700 is to 300, which is 7 is to 3. Clear? So this was a relatively simple question, right? But the idea of this question is to make us understand real concept of leveraged buyouts, right? Why we call leverage? Because we are leveraging the funds on debt to acquire a company. Target shareholders capture 40% of synergy value received. Okay. So I think synergy is evident from here only, right? With what is the combined value and what is the individual value, the synergy is coming from here only. Yeah. So let's start with solution of question number 13, students. So let's first put down combined firm value after merger is equal to 4,500 lakhs. Standalone values, acquirer, target. Acquirer is 3,000 lakhs and target is 1,000 lakhs. Calculate. Sorry, this is part of the question. Now we are doing the calculation of synergy. Sorry. So synergy is given by combined firm value after merger minus standalone values, right? So this is 4,500 minus 3,000 plus 1,000, right? So this is 500. So 500 extra value is attributable because of synergy, right? That's the pure logic of how the synergy has arrived in the overall context, right? So synergy comes out to be 500 lakhs. Okay, then target share. Within this 500 lakhs, 40% is given from the target perspective, correct? So within this synergy, 40% belongs to target. That's what we are saying, that 40% of this belongs to target. So it comes around 200 lakhs, right? This is what the target value is. Now, what's the question saying? Lastly, is sorry, So it is saying that if target shareholder captures 40%, then what is the value received that we have to calculate, right? Now, in this case, the value received will be computed how? Value received will be on account of two things. One, their share in synergy plus the original value of them, which is the 1,000 lakhs. Yeah. So value received will be standalone value of target plus share of share of target in synergy. So this comes out to be 1,000 plus 200. That means 1,200 lakhs. So this is the value received by the target company. Clear? Another way to look at is, so some of you might be thinking that we could have also done 4,500 into 40%, right? So the other way would have been that 4,500 is the combined entity into 40% is their holding, right? That's what we got it confirmed. If you do this, the value comes out to be 1,800 lakhs. But this will not be the right method. Reason being, the synergy benefits is restricted to 40% to them, and they will receive what is their standalone value of 1,000 rupees as is. Correct? So hence, from a bottoms up calculation, the overall value received is 1,200 lakhs. So this is not the right part, right? Only the 1,200 lakhs. This is the right solution. Clear? So we are done with question number 13. I hope this is well understood. Now let's move to question number 14. Hostile bidder offers 220 per share. Friendly White Knight offers 205 per share. So there are two different offers, right? One with a with not so good intentions, they want to take over the entire organization. So they are offering 220, and one with a normal intention offering 205. Target has 1 crore shares. Calculate sacrifice made by the shareholders if White Knight is chosen. Simple. I think it's only a difference in the number that they are getting from hostile bidder versus the number that they're getting from the friendly White Knight in terms of the offer that they are quoted. So let's come to solution 14. Okay. So first of all, hostile bidder is at 220 per share. Friendly White Knight is at 205 per share. The target is 1 crores shares, that is in total, that is given to us. So in case White Knight is selected, then per share difference is 220 minus 205, correct? So there is a difference of 15 rupees per share. The total sacrifice one crores number of share multiplied by 15 per share. So that means 15 crores is the overall sacrifice done by them. Okay. Let's move to the last question from the assignment. Indian company acquires foreign target. Purchase consideration is 900 crore. Expected annual synergy after taxes 120 crore only for 10 years. Cost of capital is 10% and present value interest rate factor on annuity basis for 10% 10 years is 6.145. Calculate the present value of synergy and net present value of acquisition. So they are asking us to calculate the NPV as well of the acquisition. So with whatever facts that are given in the question, we have been given about the purchase consideration. We have been also given about what is going to be my future benefits. So we are required to compute the present value of synergy and then NPV of acquisition. So let's come to solution 50. Okay. Purchase consideration is agreed to be 900 crores. Correct. Expected annual synergy after tax is given as 120 crores, but this is limited to 10 years. Right? This is not going to continue for perpetuity. It is going to be restricted for 10 years. So the present value of synergy will be expected annual synergy after tax multiplied by present value interest factor for annuity 10%, 10 years. Yeah. So this is 10%, 10 years. So ultimately 120 multiplied by what was the factor that was given in the question? 6 point, just a second, 6.145. 6.145. This was the factor that was given in the question. So the present value of synergy comes out to be 737.40 crores. Clear? So for 10 years, 120 crores present valued at 10% will give us 737 crores. And the net present value, how are we going to calculate this is using the what is my cash outflow and what is my cash inflow. So present value of cash inflow minus present value of cash outflow. So in this case, the present value of cash inflow is 737.40 crores minus, and the present value of cash outflow is actually 900 crores. Correct? Because this is the purchase consideration that I am discharging. Although since nothing else is given in the question, hence we are just assuming that synergy is the only cash inflow. But in reality, there will be regular cash inflows also, right? Over and above synergy, because synergy is over and above your regular business operations. So if this is over and above, then there will be the regular business operations related income as well, which we are saying in this case, it's not there, hence we are not assuming anything. So finally, the NPV is actually coming out to be negative 162.60 crores. Since NPV is negative, the acquisition is not recommended. Clear, students? So with this, we come towards the end of the session on mergers and acquisition and startup finance, along with these questions. Now I request CA Ashish sir to please help with the concluding remarks.
Thank you, Devas sir, for putting all the efforts, and especially special thanks for framing this totally new questions. Student, I really thank the from on behalf of Board of Studies to CA Devas Gupta sir, because they
Sure.
have framed these questions himself. Okay, and these
Right.
questions were very good questions and small questions, but very conceptual based questions. So I think student must have got the clarity. So any student have any query, they are, I think, open is session is open, so they are free to ask. And sir, I really thank you for when you have started making clear the concept, like you have started with the perfume making company, then how it moves to the deodorant company. So I think it is experience speaks. So because sir has been associated with this type of a company, so I cannot take the name on this platform, but because it is a practical experience that sir has explained. So thank you, sir, for your sharing your practical experience and making it making it understood to the students from academic point of view as well. So student, and one more point, the sir has told you, whenever any swap ratio is considered, generally the swapping is basically on the basis of like equity value and cash price is paid. Of course, generally book value is important, but book value is not that much important because book value is generally based on the historical cost concept. So this may not does not have any value. May have a value because in some questions we take some proportionate value. Of course, it is we cannot ignore it all, but generally in maximum question you will see that either the market value is the base or the cash premium base, whatever the base, but solely book value generally these are cannot be the base, or these are generally avoided. And very important one more point, when in case of a bank, when there was a sir has told you, when there is a particular factor non-performing asset, and he has very clearly made you clearly understood that it should be on reverse order because a bank with a negative NPV, that is a key performance indicator, should not be used. Otherwise the bank who has at a loss will get a more shares. So this type of a
Yes.
particular things that has to be taken care of. So it was a very wonderful point, and sir, you have explained very lucidly and very. I think it is a very catchy point, and that will be remembered by the student in their examination as well.
Examination.
Uh,
Yes.
and so, sir, thank you very much
Yes.
once again. Student, thank you very much for your patient listening. As customary, I'm sharing with you our email ID sfm-final@ica.in. If you have any query, you can send us a mail, or you can also contact me on this phone number 0120 3045 956. So student, please, since exams are approaching near, so with this, we have come to the two important chapters. Startup finance is basically theoretical oriented chapter, and merger acquisitions and corporate restructuring is basically theoretical as well as numerical oriented chapter. So both case scenarios as well as descriptive questions comes approximate about 10 to by I think 12 to 80 16 marks. So I hope this now you will not face any problem in the examination. Thank you very much, student, once again for patient listening, and thank you, Diva sir,
Thank
once
you, sir.
again, and have a nice day. Thank you.
Thank you,
Thank
sir.
you all.
Have a nice day, sir. Have a nice day.
Thank you.
Thank you.
Session over. Thank you.